ಚೆಕ್ ಮಾಡಬಾರ್ದು ಹಾಕಿದ ಫೋನ್ ಹೊತ್ತಿದ್ದಾಳಕ್ಕೆ ಗೊತ್ತದ. Good morning, everyone.
Good morning, sir.
Very few people joining in. Okay, anyways, it's 12. Ashwini, how come there are two IDs of you? Ashwini Jirli. Okay, we'll start with the taxation part of it. Today we have a tax class. So we'll start with the taxation part of it. Quickly, we'll just summarize. Tanas, can you just summarize what we discussed so far? Please come into the video mode, every one of you. Is Tanas there? So, Tanas, can you please summarize as to what we discussed in yesterday's class or the previous class, not yesterday's, but the previous class? We are talking about taxation. I started with capital gains. I discussed something about capital gains. Can you just summarize any point as far as capital gain is concerned? Is Tanas here?
Hello.
Yeah, Tanas. Can you summarize what we discussed? Any points as far as capital gain is concerned? Tanas, you're not audible.
Hello.
Yeah. Yeah, go on, Tanas. I think we have lost connect. Okay, can anyone summarize it? Gautami, can you just summarize something about capital gains quickly? Gautami, please unmute and just summarize what we discussed in capital gains. Unmute.
So capital gain is a gain which is
Loud.
capital gain is a gain which is incurred by selling the capital assets. It can be long term or short term. Short term are which are sold within 1 year, and long term are which are sold within 32 months,
36.
36 months.
Okay.
And you had explained the definition of assets which do not form a part of capital assets.
Okay. We discussed with what
Transfer.
do you mean by full
What
value
is
of consideration?
full value of consideration? What is
Okay, then we
transfer?
also discussed concepts of what do you mean by cost of acquisition? What are the things that should be included in the cost of acquisition? Correct?
Yes, sir.
Okay. So this is what we discussed in the previous class. What do you mean by full value of consideration? Okay. And then we also discussed what do you mean by cost of expenditure and also what do you mean by cost of acquisition? Clear? So this is what we discussed in the previous classes. Okay. I think I stopped here in the last class. I told you to read this particular definition and then I said I will explain you this, okay, with the help of a problem. Clear? Of course, I have to first give you the problem and only then you will be able to solve it. So we'll do it today. Okay. Today I'll be taking an extra class of taxation itself, or we'll do one thing. The investment management class that I have, I will continue with taxation itself because we are lagging a bit as far as taxation is concerned. So I will not be taking an investment management class today, but in place of that, I will be taking taxation class only. In that particular class, I will be discussing a full-fledged problem on the concept of cost of acquisition and transfer in case of depreciable assets. Okay, so how treatment has to be given, what are the things that have to be considered, all those things we will see in this part. Clear? So I will repeat once again. uh, Assets are classified under different blocks. We have different blocks for different assets, starting from 5%, 10%, 15, 20, 25, and software goes up to 60% of depreciation. So in all these ranges, any asset will fall in any of those particular categories. Based on that, we have to find out what is the written down value in that particular block of assets and how do we need to treat that particular asset, right? I'll just give you a simple example here. Let us try to understand the condition number one. It says when the computation, when the written down value is zero. Now suppose when I say that, let us say I have furniture in my office. Okay, I will not say furniture. I have a machinery in my company. Okay, and this machinery falls into 10% block of depreciable assets, right? Now I have used that particular machinery. I have purchased that machinery for 10 years. Okay, every year uh, I have a depreciation of, I apply straight line value method of depreciation, and over the 10 years I depreciate the value of that machinery, right? So which means at the end of 10th year, in that particular block of 10%, there is no asset, or the asset written down value of the asset will become zero. Do you agree with me? I repeat, I have a machinery which is worth 10 lakhs. I purchased it 10 years ago. I started depreciating the machinery on straight line value method, which means 10 lakh divided by 10 years, which means every year I can depreciate around 1 lakh rupees. So 1 lakh rupee every year for next 10 years means 10 lakh rupees. So which means at the end of 10th year, my return down value of that particular asset is going to be zero. Do you agree with this?
Yes, sir.
Yes, sir.
Now, if this is a situation, I'm giving you a situation wherein a return down value of the asset is zero. Now, in such case, what should we do to arrive at cost of acquisition and transfer in case of this particular machinery? What we need to do first, find out the value of depreciable assets which fall into, which have been transferred in the previous year, that fall within the same block of assets. What does it mean? It means that apart from one machinery which is in 10% block, I might have also had another machine which is also falling in this particular 10% block. Okay, so in case if I have transferred that particular machinery or I have sold that particular machinery, I need to find out, okay, what is the value of that particular asset. Okay, first. Then after I do that, I have to find the total of the following. What are those? What are the expenses incurred wholly and exclusively for such transfers? So if I have to, if I have to sell that particular machinery, probably I have to pay for transport charges. The person who is going to buy the machinery might send some inspection team to go and inspect that machinery. That is an expense. So all those expenses are incurred exclusively only for that particular machinery. Why? Because I want to transfer, I want to sell that particular machinery. So that is one expense that I have to take into consideration. Next, I have to take down the written down value of the block of assets at the start of the previous year. Okay. And then we have the actual cost of asset falling within the same block of assets, okay, acquired at any point during the previous year. Now, understanding these 3 points is a bit complicated. I do know. Even if I read it and try to explain it, you will not be able to make any sense out of it because you don't have figures in front of you, right? So in the afternoon class, I will be talking about these figures. I will be taking an actual problem and helping you to understand these 3 points. As of now, just understand that whenever there is a block of assets and written down value is zero, okay, what we need to do, we have to find out step number one and we have to find out step number two. Okay. Once we find out step number 1 and step number 2, this is the condition that we have to take into consideration. If step 1, that means this value, if this value that we have calculated using point number 1 or step number 1 is greater than the value that we have found out by using step number 2, then the difference is equal to short term capital gain. Okay, the difference is short term capital. If there is the value, if the value is 0 here, if the value is coming 0, there will be no short term capital gain tax. Now, can any one of you, okay, who has studied accounts thoroughly well, can anyone tell me why did I classify that particular asset as short term capital asset? Because I told you I have purchased this particular machinery 10 years back. Okay, after 10 years I have sold that particular machinery. When I do this, it, technically speaking, it is classified as a long term capital asset, and any gain that I have will be long term capital gain. But why did I write short term capital gain here? Why did I not mention long term capital gain? Can any one of you please explain me this? Give it a thought. Okay, this is a part of your accounts. This is a part of your depreciation that you have studied in the previous semester. Can anyone tell me why did I not write long term capital gains, but why did I write short term capital gains?
So is it that we are dealing in the business of machineries?
See, if I was in the business of machinery, then I will never have cost of acquisition, right? And I'll never have transfer. Then it becomes my sale. It becomes my, what is it? All these machineries become my current assets. They will not become my capital assets. We are talking about capital assets,
Yes, sir.
right?
So the
I guess
written down,
Yes, yes, yes. Yeah, Rashmi,
so the written down value is 0.
return on value is 0. Okay.
We are not incurring any cost here, because even if the step 1 is greater than step 2, we are getting somewhere we are getting 0. Then it is not considered as long term. We don't have any value for that asset.
Okay. But here, if step 1 is greater than grade 2, then you have short term capital gain. If step 1 is lesser, if step 1 value is lesser than step 2 value, naturally there will be no short term capital gain,
No short term. Yes, sir.
right? My question is, why did I write short term capital gain? Why did I not write long term capital gain? Is my question.
It falls under special transfer, sir, like what you have thought.
No, it doesn't fall under special or something. Okay, I'll just explain to you why is this treatment given here. The reason is, every year when you write your books of accounts, every year you arrive at a new value of the machinery, right? By you give a provision for depreciation, and every year you arrive at a new value of the machinery, right? So it is as good as you have purchased that particular machinery in that particular year, right?
Yes, sir.
Yes,
Are
sir.
you getting it? Every year you give depreciation
Yes,
for
sir.
the machinery, and you arrive at the new return down value, right? Do you agree with me?
Yes, sir. Yes, sir.
So when you arrive at the new return down value, it is as good as you have acquired that particular machinery in that previous year only. So if you have acquired that machinery in the previous year only, how can it arise to long term capital gain? It has to be a short term capital gain. That is the whole logic of it. Getting the answer?
Yes, sir.
Any doubts if you're not able to understand this? See, I have a machinery which is worth, as I said, 10 lakhs. After first year, what is the new written down value of the machinery? 9 lakhs, right? After first year,
Yes, sir.
what is the new written down value of the machinery? 9 lakhs. Second year goes
Yes,
by.
sir.
What is the new written down value of the machinery? 8 lakhs.
8
Every
lakhs.
year, you are arriving at a new value of that particular machinery. It is as good as you have acquired that machinery in that particular year. which means that you are not holding this machinery for more than 36 months. Naturally, when you are not holding this machinery for more than 36 months, it arises to short-term asset, and any gain or loss that you have will be called as short-term capital gain or a short-term capital loss. Getting it? Getting the whole logic of it? Why this particular statement is written as short-term capital gain and not long-term capital gain?
Yes, sir.
Okay. We proceed with the next one. Now, second condition is computation when the block is empty. When I say the block is empty means there is no block available in that particular company for that particular asset. In such case, we call it as the block is empty. In such case, what we need to do? Find out the full value of consideration of all those depreciable assets which have been transferred in the previous year, which fall within the same block of assets, and then we have to find out the total of the three. Okay, again, I'm not going to confuse you because uh, mere reading of these statements will not be able to understand. I'm repeating it again. In the afternoon class, I will solve problems exclusively on condition number 1 and condition number 2, and I will also give you problems on condition number 1 and condition number 2 so that you are comfortable in understanding the whole logic of it. Why am I stressing on this particular segment is basically in your final exam, you are sure to receive at least 8 or 10 marks of question only on this part, section 50. Okay, that's the reason I'm focusing more on this particular part. It is very simple. You have to apply a little bit of logic, and 10 marks or 8 marks, whatever is the answer, whatever is the marks allotted to you, you are confident of getting the full marks of it. It's a very simple concept. Clear? Anyways, in the afternoon class, I will discuss all this. Is that okay? I don't want to confuse you now because mere reading of these statements and mere giving hypothetical examples, you will not be able to understand. I have to give you a concrete example, only then things will start falling in place. Okay. So I'll do that in the afternoon class. Next, if you have your mobile phones, please click this particular photograph. If not, if you want, you can quickly write it down. This is the format that we are going to use when we are computing either short-term capital gain or a long-term capital gain. Whatever it is, this is the format that we are going to use. So if you have your mobile, I would request you to click a photograph of this, okay? Or if you are using a mobile to watch this particular lecture, see to it that you have a screenshot of this particular slide. This is important because every time when we calculate capital gain, either short term or long term, I am going to stick to this particular format only. Clear? So please take a photograph or please take a screenshot of this. Fine. So now we have to see what are the parameters that we have to consider while calculating either short term or long term capital gain. Let us start with the short term capital gain because it's very easy to understand. First of all, as I said, we have to arrive at the full value of consideration. We have to arrive at the full value of consideration. Now, again, I will not go what do you mean by full value of consideration. We have already discussed what do you mean by full value of consideration. So that amount will be mentioned here. Next, whatever expenses are incurred for, expenses incurred exclusively for transferring this particular asset, that has to be subtracted from full value of consideration. When you do that, you arrive at net consideration. Okay, you arrive at net consideration. And from this net consideration, you have to subtract cost of acquisition and cost of improvement. Please note, COA stands for cost of acquisition and COI stands for cost of improvement, right? So you have to subtract these two values if they are given to you. And finally, the answer that you arrive, we call it as short-term capital gain. We call it as short-term capital gain. Now, this short-term capital gain that you have, you have to add it to your other four heads of income. That means you have income from salary, you have income from house property, you have income from business and profession, you have income from other sources, plus you have to add income from short term capital gain. You have to include only income from short term capital gain. I repeat my words. You have to include only income from short term capital gains when you are calculating your total income. Please note, you are not supposed to add long term capital gain to your total income. Long term capital gain, the calculation is completely different. Okay, I repeat my words. Add only short term capital gain. Please add only short term capital gain to the other four heads of income. When you take a total of all the heads of income, the answer that you get is called gross total income. From this gross total income, you are eligible to take deductions under chapter 6A. Okay, so whatever exemptions, whatever deductions are there, you can claim those exemptions and deductions. And finally, whatever value that you arrive, that will be called as short term capital gain chargeable to tax. Here I don't have any other income. I don't have income from salary. I don't have income from house property. Neither I have income from business and profession, nor I have income from other sources. So if I don't have any income from all these heads, the only income I have is short-term capital gain. That is the reason I have mentioned short-term capital gain chargeable taxes, whatever the amount is being mentioned here. So this procedure has to be clearly understood by each and everyone. Any doubts in understanding this part, please let me know.
So,
Yes?
so when we get the short-term capital gain after deduction of COA and COI,
Okay.
then the exemption will be under section 54, no sir, like 54B, D, G and GA, sir. These four are there for exemption. Not 6A, I guess, sir. 6A is for ATC, ATCC.
No. I'll tell you what is that.
Yes, sir.
Exemptions are available under section 54. I do agree. But
Yes, sir.
there is a condition. Okay. And when we come to rebates,
Rebates, yes, sir.
okay, that time we'll discuss
87A.
all those conditions.
Okay, sir.
Right? But as of now,
Yes,
for
sir.
understanding purpose, we will arrive at short-term capital gain. And after we arrive at short-term capital gain, we give provision for exemption under chapter 6A. Now, under chapter 6A, you get rebates. Okay, you get deductions
Yes,
under
sir.
section 86.
Deductions.
You get deductions also under section 10. Okay, and you
Yes,
also
sir.
get deductions under section 54.
54. Yes, sir.
Okay, so all these things comes under chapter 6A.
Yes, sir.
Okay, so when we come to rebate part of it and rebates and relief part of it, that time we'll discuss all those things. But as of now, for understanding purpose, or to put it in simple words, to make it fit in this particular slide, I have to mention it in this particular way.
Okay, sir. Okay.
Right? So this is how
Yes, sir.
we have to compute short-term capital gain. Clear? I repeat, tax has to be paid only on gain. You are not supposed to pay tax on losses. Clear? So in case if you have a short-term capital loss, there is no need to pay tax. Okay? Only you are liable to pay tax only if you have a gain. So that is very important, because in the last December 2019 final exam paper, they had asked a problem wherein the actual answer of short-term capital gain was negative. In other words, there was a short-term capital loss, and students, without giving a thought, have calculated tax on the negative value. It is wrong. You are not supposed to calculate tax on losses. Tax is supposed to be calculated only on gains. Please try to understand this particular concept very, very clearly. Is that okay? Fine. So now we move on to the right hand side of your slide, that is how do we compute long-term capital gains. Now, when we come to long-term capital gains, up to net consideration, it is same whether it is for short term or whether it is for long term. Till net consideration, the concept or the format is going to remain the same. It only changes here. Okay. Now, what does it change? Here I have mentioned as cost of acquisition, and here I have mentioned as cost of improvement. Here I have mentioned here as less index cost of acquisition and index cost of improvement. Now, what do you mean by the word indexed? Indexed is nothing but adjusting the value of your adjusting your acquisition value or improvement value according to present inflation levels. Okay, so I does not actually stand for just a minute. Let the train pass by. Just a moment. Okay. So here the word I does not mean inflation. It is actually the meaning of the word I is indexation. Okay, indexation is nothing but adjusting the cost of inflation and then arriving at your index cost of acquisition. Any doubts in understanding what? Anyways, I have not come to the concept of indexation. I'll come to the concept of indexation and then I'll explain to you what does it mean. But try to understand there is something called as index cost of acquisition and index cost of improvement. Some value has to be mentioned here. Please try to know that. Okay. So when you finally arrive at the next value, what you get is long-term capital gain. Okay. So you arrive at your net consideration. From your net consideration, you subtract indexed cost of acquisition and indexed cost of improvement, and finally you arrive at long-term capital gain. Once you arrive at long-term capital gain, okay, whatever gain that you have, okay, there are two options. Either you invest this particular money in some aspects, and after you invest this particular money in some avenues, you are eligible to claim deductions under section 54, 54 EC, 54F. If you don't invest money, then whatever capital gain that you have, especially whatever long-term capital gain that you have, it is going to be straight away charged at 20% for long-term capital gain tax. I'll give you an example. Suppose you have sold your house. Okay, your net consideration of selling the house is, let us say, 50 lakhs. Index cost of acquisition of the house is, let us say, it is coming up to 15 lakhs. So 50 lakhs is this particular amount. 15 lakhs, let us say 35 lakhs is your cost of acquisition, index cost of acquisition and index cost of improvement. So 50 lakhs minus 35 lakhs, your long-term capital gain is going to be 15 lakhs rupees. 1 lakh, 15 lakh rupees is going to be your long-term capital gain. Now there are two conditions. First condition, if you do not invest this 15 lakh rupees within a specified time, you have to pay 20% of 15 lakhs as tax. You pay that tax and you enjoy the money whatever you have got. That is one option. Second, if you do not want to pay tax, then whatever gain that you have got as 15 lakhs, this amount has to be invested in some avenues. And after investing your money in that particular avenue, you need not pay tax on that particular amount. Are you able to understand? And the benefit of investing this particular 15 lakhs in certain avenues, you can claim the benefit under section 54. Okay, so this provision is applicable for long-term capital gain. Clear? And after investing all this money in section 50 under certain parameters, if still something is left out, that money is going to be charged to long-term capital gain tax. Clear? I will give you an example again today evening in the class to understand this particular concept. Is that okay?
Yes, sir.
Yes, sir.
Any doubts in this?
No, sir.
Okay. Now, this is something important for us to understand. I think I have time. Yeah, I have time. I'll just explain to you what is this. This is called capital gain deposit scheme. Okay. Now, what is this? Why is this? Why is this important, especially in terms of capital gain deposit scheme? What happens to your money if you invest your money through this particular avenue? All this is what we have to understand. I'll take a very simple example and then we'll try to understand. Let us suppose I have sold my house for 50 lakh rupees. So 50 lakh, 50 lakh rupees is my net consideration. I'll take the previous example itself. I have acquired that house, or I have purchased that particular house for 35 lakhs. And after purchasing the house for 35 lakhs around 10 years back, okay, I have sold that house today for 50 lakh rupees. Technically speaking, I have a gain of 15 lakh rupees from this particular transaction. Now, once I get this 15 lakh rupees, the income tax authorities are going to give me two options. They say, if you have sold your house and if you have acquired a capital gain of 15 lakh rupees, in such case, you invest whatever money that you have received by purchasing another house, okay, or you invest your money into certain government approved schemes. I repeat, I sold the house for 50 lakhs, I acquired the house for 35 lakhs, my capital gain is going to be 15 lakhs. The income tax authorities immediately come to know that a particular transaction has happened. They give me two options. Either I have to pay tax on 15 lakh rupees at 20%, okay, and pay the tax and enjoy the remaining money, or else if I don't want to pay that 20% tax, the government gives me two options. One is you buy another house, then you need not pay uh, tax on 15 lakhs. If you do not want to buy a house, then you have to invest this 15 lakh rupees into certain government section, into certain government at certain government avenues, by which government will use your money for a certain period of time, and then you need not then you need not pay tax on that particular amount. Clear? So this provision or this option is given to us by the income tax authorities. Indirectly, it is given to us by the government of India. Now, it might so happen that the moment you got this 15 lakhs, you might feel that I do not want to buy a house immediately. I want to buy a house probably 1 year later. Okay? Or you feel that in 15 lakh rupees, you are not able to build a house. You need some more money. So you may take a loan, or you may sell some other properties, or you may use your own savings to buy another house. Let us suppose you want to buy another house and you approach a builder. The builder says, I require 1.5 years to complete this particular building, right? The income tax authorities tell you that since you have decided to buy that particular house, what you can do is, instead of keeping this money with you, you open an account with State Bank of India under the head capital gain deposit scheme, and invest this particular money into capital gain deposit scheme. You put your money in that particular scheme. If you put your money in that particular account, if you put that money in that particular scheme, we are not going to charge you any tax. But on the other hand, if you put this money in your own savings account, we are going to straight away charge 20%. Clear? So what does section 54 and all the sections of 54, that is B, D, F, G and GA, they allow you 2 to 3 years of time for investing in new assets for the purpose of claiming exemptions. If you do not use this capital gain deposit scheme, then you have to pay tax. Otherwise, you open an account with State Bank of India, transfer all this money into that particular capital gain deposit scheme for next 2 years, or in some cases for next 3 years, you will not be charged tax. But within this, after these 3 years, if you have still not invested this money, then 20% will be charged to you. I repeat, the government is going to give you 3 years time to invest this particular capital gain that you have in any of the assets, either a home, either a commercial property, or if you don't want to invest into physical properties, they will ask you to invest into certain government investment avenues. You have 2 to 3 years of time depending on whatever section you select. If you do not invest your money within that particular time frame, at the end of third year, the government is straight away going to charge 20% capital gain on that particular amount. Are you able to understand this? If you use this money within the next 3 years by either buying another house, a commercial property, or investing into certain government avenues, then in that particular case, the government is not going to charge any tax on this 15 lakh rupees. are you able to understand the whole concept of how this particular capital gain deposit scheme works out? Any doubts here? Okay, so this is what I wanted
No,
to
sir.
explain you today, a capital gain deposit scheme. Okay, you have a theory of capital gains deposit scheme, and you have all the sections of section 54. So what, under what heads can you claim capital gains? So it is section 54, 54b, d, all these things. This is also an important question. It is usually asked for 10 marks. Okay, so the answer starts here and goes up to next 3 or 4 slides. Okay, so this is how this particular section 54 works out. You might feel it is very difficult to remember and other things. It is not actually difficult. It is very simple to remember. Only thing is you have to pay attention to certain points that I'm going to tell you in my next class. Next class means I will not explain to you this today. I will be solving problems on depreciation today in the afternoon class. Whenever we have the next tax class, probably tomorrow or day after, at on that particular day, I'll be discussing exemptions related to capital gains. Is that okay?
Yes, sir.
So we'll
Yes,
stop.
sir.
I just want to take the attendance. Please switch on your video mode. So we have only 25 people here. From today onwards, whatever attendance I take, it will be posted immediately in your group, so that you also know that these are the people who have attended the particular class. Okay. I cannot see Vishnu here, Rohit and Shaila. Same is the case with Sushmita and Akshata. Okay, fine. So we'll stop the class here, and my next class will continue from where we had stopped.